Today we're looking at an analysis of CRDO Technology Group's Q2 earnings, which were, well, explosive. A 272% year-over-year revenue jump.
A monster beat. The report nails the headline numbers. $268 million versus $72 million last year.
And what really stands out are those gross margins, 67.7%.
Exactly. That's elite territory. It tells you there's real pricing power there, which brings us to the first point of feedback.
Right. While the report brilliantly identifies the active electrical cable, or AEC, technology as CRDO's secret sauce and growth driver, the analysis could benefit from a deeper stress test of the molt's durability against, future tech shifts.
Yes. That's the whole game right there. Those 67.7% margins, that's not a hardware company. That's a software company margin. It screams technical differentiation.
And the report lays out that advantage well. AECs are cheaper, they use 50% less power than optical for short distances, but it kind of assumes that advantage is stable.
It treats it as a static fact, and that's the weakness. For a high-level financial analysis, you can't just state the advantage. You have to defend it.
Especially in this space. The AI interconnect world is moving at lightning speed.
So this omission leaves the analysis a bit vulnerable. What happens if copper tech gets faster? Or, and this is the big one, a new short-reach optical solution closes that 50% power gap.
Suddenly, that incredible margin is at risk.
So the suggestion for improvement is to strengthen the analysis by explicitly examining the potential timelines for commoditization or disruption. You have to build a case for why this edge lasts.
Okay, so let's get concrete. How could you do that?
Well, one way is to directly address what competitors are doing. You could analyze the R&D spend of key rivals in, say, high-speed copper or short-reach optical.
Sort of ask the question, are they spending enough to make you nervous in the next, 12 or 18 months?
Exactly. Frame it as a threat assessment. Another approach, which I think is even stronger, is to model a sensitivity case.
A what-if scenario.
Right. What if a competing optical solution gets a 30% reduction in power consumption in the next year and a half? How does that immediately hit CRDO's pricing power?
That makes the threat tangible. You're putting a number on it. It forces you to think about how much of that 67.7% margin is truly defensible.
And a third way to think about this, map the AEC product lifecycle against the typical hyperscaler adoption curve.
So when do big players like Microsoft and Amazon start phasing in the next thing?
Precisely. Is this a 2-year upgrade supercycle? Is it 3? Defining that boundary moves the analysis from just capturing today's excitement to actually forecasting its lifespan.
That's excellent. It secures the whole thesis. Okay, let's pivot from the tech moat to the customer base, because that's the other side of this rapid growth story.
A very glaring one. That $268 million quarter is fantastic, but it rings some alarm bells on concentration.
The analysis does correctly identify customer concentration as a primary risk. It notes that a huge chunk of that revenue comes from just 2 or 3 massive clients.
Right. You have to assume it's the big AI cloud providers. But the report, it just states this risk too briefly. It needs concrete scenario modeling.
It flags the risk, which is step 1. But it stops there.
And for a company that's moving from being a sort of small-cap darling to a critical infrastructure provider, that concentration risk is, well, it's existential.
Yeah, a simple footnote in the risk section just doesn't cut it. It needs to be quantified.
The weakness here is treating it like a footnote instead of a core financial dependency. So the suggestion is to directly integrate scenario analysis into the risk section. Model the dependency.
And show potential paths for, diffusion.
Exactly. So let's talk about how. One really effective way is to create that what-if scenario again.
Okay.
Model the exact impact on their Q3 guidance, which is, $335 to $345 million, if their largest client cut spending by, say, a moderate 20% next quarter.
Maybe due to an inventory adjustment or a project delay. Something completely plausible.
Right. That forces the reader to confront the real, immediate volatility here. Another idea is to look at the diversification that's already happening.
They mention a 5th hyperscale customer that's ramping up.
Yes, so analyze that. Explicitly assess how fast that new customer needs to ramp up to reduce the revenue dependence on the top 2 by a specific target, maybe 10%, by the end of the fiscal year.
I like that because it turns risk mitigation into a measurable goal. It's not just, we hope to diversify, it's, we need this customer to hit X revenue by Y date.
It shows the path out. And one more thing on this. The report mentions clients like Tesla or XAI almost in passing.
As a footnote to the ecosystem.
Right. Frame that differently. A third suggestion is to present that as a deliberate strategy for risk diversification. Find data points on their expected volume growth to show how they're actively counterbalancing the reliance on the big guys.
You're showing the diversification happening in real time. It's not a hope, it's an active process.
Exactly. You prove it.
That's a much more robust way to handle risk.
Okay, so from present risk to future growth. This is where the stock's high multiple comes from.
It has to be. And this is where the analysis feels a little disjointed.
How so?
Well, it introduces these really exciting new products in the forecast section. Zero flap optics, active LED cables.
Stuff that could double their addressable market, it says. It does. Yet it fails to weave that future potential back into the immediate investment thesis that's being driven by the current AEC supercycle.
So the weakness is that these new products are presented as like a separate future thing?
Exactly. They feel like an optional add-on rather than an integrated part of why analysts are putting $220, $250 price targets on the stock right now.
It misses the chance to explain why Wall Street is applying such a high multiple to what are today purely AEC earnings.
Yes, they're not just paying for Q2, they're paying for how CRDO leverages this win into dominating the whole interconnect stack.
So the suggestion, explicitly connect the near-term success with the mid-term acceleration from new products.
You have to tie them together to justify the valuation.
You have to.
Okay, so for a specific fix, you could go back to that analyst reaction section.
And try to break down those price targets. Clarify which portion of, say, that $250 Rotham Cam target is probably based on the Q3 guidance.
The here and now.
And which portion is premised on the anticipated success of something like zero flap optics.
Segmenting the valuation drivers. That's sharp. It adds a ton of clarity. Another suggestion is to use these new products to stress test the full-year forecast.
The 170% growth outlook.
Right. Are the new ALCs expected to contribute anything meaningful to this fiscal year's number, or are they purely an FY 2027 story?
Making that distinction is critical for managing expectations. It tells the reader when to expect that next S-curve of growth to kick in.
It sharpens the whole forecast. And a final strategy here is to structurally link the new product development back to the existing big clients.
Are being designed to solve a specific problem that, say, Microsoft or Amazon has right now?
Exactly. Is it a power problem, a density problem? If you can make that connection, it suggests a near-guaranteed initial uptake from their biggest customers.
And that transforms a potential future product into something that feels much more like a pipeline certainty.
And that is what underpins the massive multiple the stock is getting today. You're connecting all the dots.
So this analysis on CRDO's growth is off to a great start. It absolutely nails the financial triumph. To really elevate it, we've outlined 3 key areas for refinement. First, we need to deepen the analysis of that AEC moat's longevity. That means stress testing the competitive landscape and modeling disruption timelines.
Second, rigorously quantify and model that customer concentration risk. Go beyond just acknowledging it and build out some what-if scenarios, while also showing the clear path to diversifying that revenue.
And finally, fully integrate the future product roadmap, the zero flap optics and ALCs into the immediate valuation narrative.
You need to make that connection between the new products and today's high analyst price targets completely explicit.